Hey there, Matt the Mortgage Guy. In this week's video, I'm going to talk about the future of interest rates. No better week than this week when the Fed has been very active in not only their meeting and their comments, but their forecasting for what they're going to do in the future, when they plan to raise the Fed funds rate, how that correlates to mortgage interest rates, how that might affect you as a consumer. I'm going to jump into all this. Before I do, if you do me a huge favor, like, comment, subscribe, do all the stuff that helps support this channel. I try my best to take time out of my busy day as a mortgage broker to tell you what I'm hearing, what I'm feeling, what I'm seeing. Hopefully it helps you out. Whether you're in the market to purchase a home, whether you're thinking about refinancing, anything to do with mortgage and the housing market, my input as a mortgage broker who talks to hundreds of people every month, hopefully is helpful and important for you, whoever's watching this, right? And so without further ado, I'll jump into it. This week has been a volatile one, and the Fed came out, it was either Tuesday or Wednesdays, the comments where they, for anybody who doesn't know, they've talked about raising the Fed's funds rate, which got down to zero. And I remember it real distinctly because when it got to zero, everybody reached out to me and said, oh, mortgage rates are at zero. Great. Where do I sign up for my 0% mortgage loan? Not exactly how it works. The Fed's funds rate, them lending money to each other, is different than the 30-year fixed mortgage rate. But as you'll see from this chart, they're relatively correlated, right? And look at this. This is mortgage rates in orange and the Fed funds rate in blue. And, you know, day to day, week to week might not necessarily correlate, but over time, you can definitely see there's a correlation, right? And back here in 2020, when we got down to zero on the Fed's funds rate, rates down. And here's the idea, and here's the thought process, is initially they said, we're going to keep rates low. We're going to keep buying mortgage-backed securities. We're going to keep this Fed funds rate at zero through 2024. Then through some comments, well, maybe it'll be 2023. I think it was Bullard, who sits on the panel, who said maybe 2022 is when we'll do our first rate increase. So that date keeps getting pushed closer, right? And I've said it time and time again until I'm blue in the face, especially when I'm talking to refinance clients, is this likely is not going to last forever. It shouldn't last forever, this low interest rate environment. We can still be low, but as far as low as we are now, this might be short-lived. And so if you like it, lock it. Let's get your refinance plugged in. What is likely to happen is that 2022, 2023, you start to see slow tick ups, a quarter, 0.5, 1% in the Fed funds rate. And as we see here, it's somewhat correlated, might not affect it week by week or month by month, but from one year to the next. Moral of the story, we're likely to see higher interest rates in the future, right? And so this is your warning. And I thought that this was a really funny beginning of an article. It was great marketing, right? Where Yahoo said the party's not over for homeowners looking for refinance savings and home buyers hoping to land cheap mortgages, but the Federal Reserve may have just announced last call. And so the party's not over, but they've just let you know, hey, last call. If you're looking for an interest rate on a mortgage around 3%, you might just want to mosey on over to the bar and order up, because they're going to be walking around collecting drinks, collecting cups here shortly. And this goes into, I'll leave these links down in the description. The Fed, because they release a dot plot, and different members of the Fed have their own predictions on when they're going to raise that Fed funds rate. And some say 2024, 2023 and whatnot. And so they released it. And it's like anonymous. You don't know who's who. You just know that there's a lot of people in this camp, a lot of people in that camp, as far as when that is going to raise. And what does it say here? Expect to raise interest rates twice during 2023. And that was like the consensus, right? And just 3 months ago, that was 2024 was the consensus. And now we're 2023. And then Bullard comes out and says, well, I think 2022. To me, that signals they realize they need to not wait 3 years, and they can't keep this pressure on rates and hold them down for ever. And so really interesting stuff. Before I end this video, I wanted to share this because I really like Black Knight. They have just really awesome data. And Andy Walden was on talking a little bit about how the Fed and their policies and their moves is going to affect the mortgage rate. And I think it's really good stuff. So I just want to play it and then maybe comment on it.
He's economist and director of market research for Black Knight. Andy, it's great to have you here. Please explain this mystery for us. What is going on in the mortgage market?
Yeah, I think what you're seeing is kind of somewhat of a return to norm. If you look over the last 5 years or so, I mean, historically, there's been about a 2% spread between 30-year mortgage rates and 10-year Treasury yields. With all of the bond buying or mortgage-backed security buying the Fed has been doing, it's really tightened up those spreads. And so the increased spread that we're seeing is likely in response to kind of the expectation of a somewhat return to more of a normal market.
And can you also tell us what the expectation is right now in the market for this tapering? I mean,
all right, let me speak on that real quick, because what he said, if you missed it, was that in general, there's about a 2% spread between the 10-year Treasury and the 30-year mortgage rate. So the 10-year is at 1.44, and mortgage rates, it's really only like a 1.5% spread right now. Mortgage rates are closer to 3%. And so what he's saying is we're starting to see a return to normalcy, meaning there would be a full 2% spread between this 10-year and the 30-year fixed mortgage. And in my head, what that means, many people predict the 10-year to get to 2% by the end of 2021. And if we slowly see that return to normalcy where there's about a 2% spread between that and the 30-year fixed, that puts the 30-year fixed at 4%. I personally don't think it's going that high, either one of them. But what if this is at 180 and rates are 3.75? I mean, it's completely possible. So it's something to look out for. And as he states, Black Knight data has some of the best data out there, and these guys know a ton. There's also big data aggregators like Redfin and whatnot who are collecting data, and I follow what they say because data doesn't lie. You know, you can have hunch and you can have feel and you can think a certain way, and I can tell you about conversations I had, but data does not lie.
What do they think is going to happen on the mortgage piece and on the Treasury piece?
Yeah, and I think that's really what the market's trying to understand and kind of figure out. We're kind of in a phase where we're talking about it right now, and so I don't think there's a set plan in place. And so I think the market's trying to determine and make expectations for where that may go, and it's simply an unknown at this point.
So if you're saying we're kind of going back to normalcy here in terms of the spread between the 10-year yield and the mortgage rate, I guess the question is, what does that mean for the housing market? If we've enjoyed a period where that spread was lower than normal, so mortgage rates are kind of lower than normal, with everything going on in the 10-year, does that mean that we should expect to see rates edging higher now, even though the 10-year has slumped this week?
Yeah, I mean, I think that's the long-term expectation, and when and where that'll take place and by how much and how quickly, I think is still up in the air. But I think the broad expectation is for mortgage rates to kind of gradually or maybe even sharply at points rise over the next couple of years. In terms of what that means for the mortgage market, if we look at affordability, even before this recent interest rate move, we were already kind of at a point in the housing market where we should start to see some inflection. We should start to see some slowing and deceleration to norm. This obviously pushes us farther up that chain. But the challenge in the housing market is that there's so little inventory that we're continuing to see red hot prices, even though your quantity volumes, your lock volumes, your pending sale volumes are falling. And so we're kind of seeing a dynamic where the housing market continues to rise faster than it should, even in a rising rate environment, because there's no inventory out there.
Interesting. So basically, if we had, all the supply we needed, we might already be seeing prices correct a little bit more than they had. This kind of goes back to what we learned today from Redfin, where they were saying that the housing market activity probably peaked around 8 or 9 weeks ago. Do you think there's some truth in that?
Well, I think there's two different things to look at. One is quantities, right? So if you're looking at application volumes or optimal blue rate lock volumes on purchase lending or pending sale volumes, I think those could trend in a different direction than prices. simply because we're in an environment where we have 60% lower inventory than we should have. We continue to see new inflow of inventory run at 25% lower than it should be, and you can only sell what you're listing. So we could see quantities fall, applications fall, pending sales fall, at the same time home prices continue to rise.
That's so fascinating. So, sort of spin this story forward a year or so, Andy, where are we in terms of housing market conditions, do you think?
Well, I think that's really the question and the concern for the market, right? The question is, what happens to affordability? We know that we're relatively level now. We're kind of at a point where we should be slowing, but it's not overly concerning. Where are we at if home prices continue to rise like they are? And then we start to see some tapering and we see some sharp movement in 30-year rates. I think that really starts to put pressure on the housing market. So I don't think it's a known, but there's certainly a concern there of how that could play out over the next 12 months.
All right. Good stuff. I really enjoy his take. And I know that Black Knight Data just has, really good information to share. So I won't rant on for too long. But just with all that being said, I think it's important to realize, like he stated, if we have, the quantity of sales going down, like not as much stuff selling, it's still likely we're going to see prices increase because there's so much demand. So less houses can be sold. There can be, rates can go up and these different things can happen, but it doesn't mean prices are going to correct. And I think that is one of those things that really people misunderstand, is they think that like, oh, if supply goes up or demand goes down, we're going to have everything on sale for 20% off. It's just not the case, right? There's just so much room for that. And so just in closing, just to close on what I started the video on, and like what are mortgage rates going to do for the second half of 2021. I wanted to bring up this chart because this is mortgage-backed securities. And so this doesn't mean anything to anybody as far as the exact rates, but you saw that 30-year that he was looking at where it said 3.25. I think as a broker, I'm probably closer to 3% on most scenarios. And so what I want to show you is this goes back to the beginning of the year, right? Rates are phenomenal, the best they've ever been. And then February, SHIT hits the fan. And rates go from, let's just call it 2.625 on a 30-year to near 3.5% at some lenders. Some lenders were still at 3.3, 3.4, right? But 3.5 at some lenders. And then rates start to improve, and we get back under 3% on clean, best scenario for some borrowers. And probably the last 6 weeks, we've kind of stayed in that range. This big red downturn was Wednesday. This was the Fed talking about, right? Bam. That is a big one-day move. That doesn't happen very often. Back here, check this out. Back here in March, that was the start of something nasty. So are we at the start of something nasty? Do I have the answer 100%? No. But would I be locking like crazy everything that comes in the door? 100%. Would I be locking if I was you as a consumer? 100%. Any questions at all, please feel free to reach out, matt@mattthemortgageguy.com. If you have an out-of-state deal, greatmortgagebroker.com. Fill out that quick form. You'll be connected to somebody I like and trust in whatever state you're in. Or like I said, matt@mattthemortgageguy.com. If you're inside California, shoot me an email. Let me know how I can help. Talk to you soon. Bye-bye.